A new AM Best research report indicates that two distinct submarkets have evolved within the U.S. cyber insurance space. One dominated by surplus lines carriers writing primary and excess cyber specific policies, and the other focused on endorsements to commercial policies. In a separately published market segment outlook, AM Best is maintaining its stable outlook on the cyber market, citing robust demand for coverage despite a softening in market pricing. We're joined today by analysts who contributed to each of these research reports, Senior Industry Analyst Chris Graham and Associate Director Fred Eslami. And Chris, let's start by discussing the overall performance of the cyber market in terms of both premium growth and the performance around losses.
Good morning, John. Thank you for having me today. Yeah, the cyber loss ratio ticked up again. This is the second consecutive year with an increase in the loss ratio. More concerning is that the loss ratio went over 50. The last time the loss ratio was over 50 was during the ransomware spike at the peak COVID era when a lot of people were forced to be working at home and maybe not all security measures were in place. So the increase in the loss ratio is a little bit of an eye-opener. Premium overall is relatively flat, we believe. There's a small increase in premium, but we believe that to be just some entities moving their premium from offshore to onshore NAIC filing entities. It doesn't seem to be any new growth in the cyber market. The other part of that is, well, how much are some of these larger insurers also keeping as a captive? We don't know that, so there may be some growth there that we're not capturing. But overall, the premium looks to be flat right now.
How do you characterize these two markets that are referenced in the report and what's behind that?
Yeah, this is a very interesting part of the cyber market. So as you noted, the primary and excess policies are dominated by the surplus lines carriers, and the endorsements for which are more for your small and medium-sized enterprises, are dominated by endorsements to their existing commercial policies. When I say dominate, I want to say like the surplus lines carriers have about 70% of the primary and excess market, and what that's bringing about is the specific needs of some of these larger insureds. They're not going to fit well in the policy language of an admitted policy. So it does work well for the surplus lines carriers to take a big share of that market. The admitted market, what's interesting here is while the premium per policy may be light, because overall the surplus lines carriers do have a majority of the premium for cyber. So while the endorsement policy premium may be light, the overall total aggregate exposure lies actually more in the endorsement segment. So you really have two different things going on. And in terms of aggregate loss, it looks like the admitted carriers have more exposure to risk than the surplus lines carriers. The surplus lines carriers obviously have the bigger risk on any individual risk. But in aggregate, if you're talking about something that would be a widespread outage hitting a number of small to medium-sized enterprises, the admitted carriers have more exposure.
Fred, AM Best is maintaining a stable outlook on the segment. What were the considerations behind that?
Well, the definition of stable outlook is that, we expect market conditions to remain stable, unchanged, positive or negative for the next 12 months. So that's the basic basis for our outlook on cyber. We know that the demand is strong, despite softening market. Profitability is still acceptable, 53 plus estimated 30 on underwriting expense. 83 is not a bad combined ratio for the industry. There has been ongoing enhancements that companies have taken to protect themselves, improve their cyber hygiene, and also the AI, which, it's a double-edged sword that I would call good AI and bad AI, and we'll get to the bad AI. Good AI, companies are using AI for claims management, underwriting, definitely, and other areas. So there is improvement there. Capacity is still available. We have seen for the past 3 years about 450 million each year. Average alternative insurance, ILS, cat bonds for cyber. Captives have been taking a large portion of the cyber exposures that parent companies have. We don't have the information on all of the domiciles that have captives, but it's a good chunk of money. In terms of regulatory regimes, they have improved substantially. New York State DFS just came up with updated regulations for companies, and California GDPR and other regulatory regimes also follow those, both on the cyber and also on the AI side.
Are there countering factors that were considered here, and are there any headwinds?
Well, of course, the ransomware, BECs, business email compromises, fund transfers, fraud, fund FTFs haven't changed. They're actually getting more aggressive. I looked at the statistics that about 75 to 80% of cyber events are basically on ransomware and BECs and FTFs. Industries is still waiting for a CAT situation, a systemic risk. A couple of years ago, CDK almost got close to being that event, but it didn't, thanks to the mitigation practices that these companies had. And also there is a bad AI. I noticed past couple of days there's a news that a cyber attack without involvement of any human was started in some Indonesian company. So all those things remain as aggressive as they are, but at the same time, there are those positive elements that I mentioned.
Thank you, Fred. Chris?
Thank you, John.
Thank you.
That was Senior Industry Analyst Chris Graham and Associate Director Fred Eslami. AM Best will hold an analytical briefing with industry executives, innovation leaders, and AM Best analysts to discuss the complexities of cyber capacities and underwriting, as well as what to expect in the future from cyber insurance. The briefing is scheduled for Thursday, July 23rd at 10 a.m. To register for this virtual briefing, please visit ambest.com. For AM Best TV, I'm John Weber.